Welcome to the Authority Hub podcast. I'm Nolan, joined as always by Claire.
And today we're featuring the expertise of Lisa Insalaco, mortgage broker in Cambridge, North Dumfries, on.
If you're a homeowner in Cambridge who's 55 or older, sitting on decades of equity, and your kids are quietly worried that a reverse mortgage will leave them nothing, what do you actually say to them at the kitchen table?
That is the conversation, isn't it? And it's one that Lisa Insalaco says comes up almost every time a senior borrower walks in for a first meeting.
So let's set the scene. A homeowner in Cambridge, maybe North Dumfries, maybe just outside Kitchener, has been in their home for 30 years. The equity is real, the retirement income is not keeping up.
And the bank has already said no to a line of credit. Maybe the income on paper doesn't support it, maybe the debt service ratios didn't work out. Whatever the reason, the door closed.
So they start hearing about reverse mortgages. And the first thing their adult children say is, what happens to our inheritance if the interest just keeps compounding?
Which is a completely fair question. Lisa Insalaco is direct about this. The concern is real. It deserves a real answer, and it is entirely modelable before any decision gets made.
That's the key word, modelable. This isn't a mystery. The math can be run across different scenarios before anyone signs anything.
But let's back up, because reverse mortgages are one piece of a much larger picture. Lisa Insalaco works across Cambridge, Kitchener, Waterloo, Brantford, Guelph, and the borrower mix in that region is genuinely diverse.
Tradespeople with variable income, newcomers building credit history, self-employed business owners whose tax returns don't reflect their real cash flow. Seniors sitting on significant equity.
And what connects all of them is that the standard lending system wasn't built for their situations. That's the structural problem we need to name clearly.
So let's name it. Claire, what does the standard approach actually get wrong for these borrowers?
The system evaluates a file against a very narrow set of criteria: T4 income, credit score thresholds, debt service ratios. And if your life doesn't fit that template, the answer is no.
Even if you can genuinely afford the mortgage.
Even then, the federal stress test requires borrowers to qualify at a rate higher than the one they'll actually pay. So someone who could comfortably make the payments still can't demonstrate it on paper under prime lender rules.
And the debt load piece surprises people. Lisa Insalaco's work points to something that really illustrates this. For every $500 a month in support payments, a borrower can lose $100,000 in mortgage borrowing power.
That compounds fast. Add a car loan, some student debt, and suddenly a borrower who feels financially stable is failing the stress test by a wide margin.
And for seniors specifically, the problem is different but just as structural. The income is fixed, the equity is enormous, but a traditional lender looks at the income, not the asset.
Which is exactly why the reverse mortgage exists as a product category. It's designed for that specific mismatch: significant equity, limited income, no appetite for monthly payments.
So let's talk about how Lisa Insalaco actually approaches this. Because alternative mortgage financing isn't one thing. It's a framework with distinct tiers, and matching the borrower to the right tier is the work.
Right. There are B lenders, regulated institutions that accept more flexibility on income documentation while still operating under federal oversight. There are private lenders who lend primarily against equity rather than income. And then there are specialty products like the reverse mortgage.
And according to the Canadian Lenders Association, there are roughly 300 active alternative lenders in Canada responsible for between $13 and $14 billion in outstanding mortgages. This is not a fringe category.
It's a substantial part of how Canadians actually finance their homes. The issue is that most borrowers don't know it exists until after they've been declined.
Which brings us back to the reverse mortgage conversation, because for the senior homeowner in Cambridge who's been turned away from a HELOC, this may be the most practical tool available.
The CHIP reverse mortgage through Home Equity Bank allows qualifying homeowners aged 55 and older to access up to 55% of their home's appraised value. No monthly payments. No income qualification required.
And Home Equity Bank is a federally regulated Schedule I bank. This isn't an unregulated product operating outside the system.
The product includes a no negative equity guarantee. The borrower will never owe more than the fair market value of the home at the time of sale, provided the property is maintained and taxes and insurance are kept current.
That guarantee is a regulatory feature, not a marketing claim, and it sets a real ceiling on the worst-case estate outcome that families are worried about.
But Lisa Insalaco is clear that the guarantee alone isn't the answer to the kitchen table conversation. The answer is running the actual projections.
Walk me through what that looks like.
A borrower who takes a larger loan at 57 and lives into their late 80s is going to see a very different outcome than someone who takes a modest draw at 72. The loan amount, the age, the property value, the timeline, all of it goes into the model.
And that model should be built across multiple appreciation scenarios, not just the optimistic one.
Exactly. The honest version of this conversation includes the scenarios where appreciation is slower. That's what makes the decision a confident one rather than an anxious one.
There's also a limitation that Lisa Insalaco flags that I think a lot of people don't know going in. You generally cannot hold a reverse mortgage and a HELOC at the same time.
Because the reverse mortgage registers as a first charge against the property. It holds the primary security position. Most lenders won't register a HELOC or a second mortgage behind it.
So if maintaining the ability to access additional financing later is part of your plan, that has to be part of the conversation before you choose a reverse mortgage over other equity access options.
That's the kind of trade-off that only surfaces when you're working with someone who knows the alternative space well. Someone like Lisa Insalaco, who's doing this work specifically in Cambridge and the surrounding region.
Let's talk about the application process, because I think the unknown is a big part of what makes people anxious about alternative financing.
It follows a defined sequence. It starts with a full financial review, income documentation, credit report, property details, and a clear statement of what the borrower actually needs to accomplish.
And that review determines which tier is the right fit before any application goes out.
For private lender applications, the process is faster because the underwriting is primarily equity-based. The critical step is the property appraisal, and once that's in, the lender confirms the loan amount and issues a commitment letter.
Reverse mortgage applications take longer because of a mandatory independent legal advice requirement. The borrower has to meet with a lawyer, independently of the transaction, to confirm they understand the product before the mortgage can be registered.
The compound interest structure, the no negative equity guarantee, the repayment triggers, all of it gets reviewed in that meeting. Lisa Insalaco treats that requirement as a feature, not a formality.
And the repayment triggers matter. The chip reverse mortgage becomes due when the last borrower on title sells, moves out permanently, or passes away.
Having that conversation early, ideally with the borrower and any involved family members, is what prevents the kind of surprises that create conflict later. Roughly 99% of home equity bank clients have equity remaining in their home when the mortgage is repaid.
Which reflects what happens when the loan is sized properly and the property continues to appreciate over time.
And for borrowers who aren't in the reverse mortgage category, the self-employed business owner, the person going through a divorce, the newcomer building credit, the exit strategy is what separates a bridge that works from one that creates more problems.
Say more about that, because exit strategy is a term that gets used but not always explained.
An exit strategy is a defined plan for what happens at the end of the mortgage term. For AB lender placement, the typical exit is improving the credit profile so the borrower qualifies with a prime lender at renewal.
For a private mortgage, the exit might be a property sale, an inheritance, a renovation that increases value enough to support refinancing at a lower cost.
The point is that it's planned from day one. Alternative mortgages have shorter terms, and without a clear plan for what comes next, borrowers can end up in a cycle of expensive renewals.
Lisa Insalaco's approach to this, across Cambridge, Kitchener, Waterloo, Brantford, Guelph, is to structure the solution with that endpoint in mind from the very first conversation.
And there's a misconception worth clearing up here. Alternative mortgage financing is not a last resort for people who've run out of options. That framing causes real harm.
Because it leads borrowers to delay conversations that could actually help them. Some accept worse outcomes from prime lenders rather than explore what the alternative space offers.
B lenders in Canada are regulated financial institutions. private lenders operating in Ontario or subject to provincial mortgage lending rules. Mortgage brokers arranging those transactions are licensed and regulated by FSRA.
And the other misconception, specific to reverse mortgages, is that the lender takes ownership of the home. They don't.
The borrower retains full title throughout the life of the loan. The lender holds a registered mortgage charge, the same structure as any other mortgage, and is repaid when the property is sold or transferred.
That distinction matters enormously for borrowers who have been avoiding the conversation based on a misunderstanding of how the product actually works.
So what does the outcome actually look like for the Cambridge homeowner who came in with that kitchen table question about the estate?
They leave with a projection, not a reassurance. A real model of what the balance looks like in 10 years, in 20 years, across different appreciation scenarios.
The family understands the no negative equity guarantee as a regulatory floor, not just a sales promise. The repayment triggers are mapped out. The estate plan accounts for the mortgage.
And the homeowner has access to equity they couldn't touch before, without a monthly payment obligation, without an income qualification, without selling the home they've lived in for 30 years.
That's what alternative mortgage financing done well actually looks like. The problem wasn't the borrower. The problem was a system that wasn't built for their situation.
And the lesson that generalizes beyond any one story is this. A bank decline is information, not a verdict, and the right broker knows how to read it.
If you're in Cambridge, North Dumfries, or anywhere in the surrounding region and you want to understand your full range of options, the starting point is a conversation, not a commitment.
Lisa Insalaco is a mortgage broker in Cambridge, North Dumfries, specializing in alternative mortgage financing.